Hey guys, my name is Ravi Sharma and I am the founder and buyer's agent at Search Property TV. Thank you so much for joining me on yet another episode. Today's episode is about how we can use the equity in our family's house, the parents' house, and how we can extract that unused equity to really supercharge your property portfolio. So I'm going to use a very simple example from a client that we've just spoken to, and I know they're not going to mind me using this. So your parents, may have bought a property, say 10 years ago. So 10 years ago, they've purchased a property and it's for 500K. So that was the purchase price. Now we know that most people, especially banks, really love giving us loans at 80% LVR, so loan to value ratio. So if that's the value, they are happy to give us 80% of this loan. So your parents would have taken out a 400K loan. Now this is 7, maybe 8, maybe 10 years ago, right? So what they've been doing, they've got the migrant mentality, save as much money, get out of debt as soon as possible and keep working in our jobs. Now, some would say that's a great strategy. Some would not really agree, like myself. However, it's not about me, it's about what they can do for you. So they would have been just paying down this loan, so principal and interest loan, and 7 to 10 years later, we now have a value of $1 million. The loan has also come down because they've been paying principal and interest, right? So this is now 300K. So in this circumstance, we've gone from an 80% LVR to now being at 30% LVR, right? So when we're at 30% LVR, we know that our parents could technically use the unused equity, so bump up the loan, take out the surplus equity, and then use that to purchase more property. But that would mean that you're getting into further debt, which obviously they don't like. However, I'm going to show you exactly how you're able to take advantage of the equity there. It doesn't affect their lifestyle, doesn't affect their repayments, and you get all the benefit. So your parents inherently have one goal in mind, which is I want to see my kids financially stable. I want to see them happy, right? And that's why they say, well, you should go out and get a job and that pays well, and then you can buy a house and then pay that down. It's a very traditional way of looking at property investing, and that's what worked for them, say, 7 or 8 years ago. However, it doesn't work anymore. And there are strategies out there, like the one I'm going to show you, that can really get you supercharging your road to retirement and having a life of choice. So getting to financial freedom quicker. A lot of people are struggling with the fact that they can't save enough money, purely because, cost of living's going up, and there may not be as much wage growth in the system as there was, 10 years ago. So I'm going to show you what's happening. So we go to the bank and we say, okay, we want to bump up this loan to 80% of our value. So the value is here. So 80% of 1 million is $800,000. So now we're going to take up this 300 and we're going to bump it in with a 500K equity loan, okay? So now we've got the original loan of 300K, and now we have the equity loan of 500K. Now, again, in this example, I just want to show you, if we were to maximize what we've got here and really push this, but you don't need to take out 500K. You could take out less and you could draw down on that equity as you go along. So how it works is if I take out 500K and decide I'm going to buy a 500K house outright, then I start paying interest on the 500K loan. However, if you're actually at a point where you're starting out your portfolio and you decide I'm going to purchase one property through Ravi and understand how it works, then you only pay interest on the portion of the loan you've actually drawn out. Now we can discuss this in a bit more detail on a strategy call. I've got a link in the description below. Just book in a strategy session. We can have a phone call, we can have a video chat, and as restrictions pull back, not sure when you're watching this, but in April, now we're in May, 1st of May, we are lifting restrictions. So this could be a conversation that we have in your living room with your parents sitting down because they're a bit concerned. How does this affect me? I've been paying down my loan. I don't really want to have another loan of 500K. Do I have to pay that off? It's not the case, but it's about knowledge. What you don't know is what you don't know. So I'm here to hopefully change your minds. So now you're going, I've got the 500K, but you're saying my parents are only gonna have to pay 300K. Continue paying the same repayments. Doesn't affect their lifestyle. And what we can do with this 500 is amazing, okay? So we've got 500K to play with. And my question to you would be, how quickly could you save up 500K? It would take you a real long time, okay? So we're gonna take advantage of this. Now, I've got some numbers down here. Now with 500K, if we were to sit down and have a strategy session, the first thing that you would probably say, especially for anyone that's under 40 really, is I don't want to be bogged down with another loan. I don't want to be more stressed out. I want choices. I want to be able to go from full-time to part-time work. I want to be able to travel with my kids or my family or my partner. You don't want to have more stress. I'm here to alleviate stress. I'm here to give you choice. Okay, so the 500K, we're going to go, okay, hey Ravi, I've got 500K to play with. What do I do? So we're gonna go and buy a $250,000 property. Okay, so $250,000. We're gonna move fairly quickly here. 20% deposit is 50K. Then you've got purchasing costs, right? So you've got purchasing costs, purchasing costs. So these would be things like, you know, building inspection, pest inspection. We've got a buyer's agency fee. We've also got stamp duty. So we're gonna say that's 20K, okay? So 50K, 20K, and you've secured yourself your first investment property. Congratulations. So that's gonna cost $70,000. Now, $70,000 is your total outlay. You have a pot here of 500. So what I would advise, although this is non-financial advice, this is purely my opinion of what I would do in this situation, is I would take the 70 and go, how many times can I leverage this and go and purchase more? So I can actually purchase 7 more properties. So 7 properties in total, sorry, which would take us to a total spend of $490,000. Now you guys are getting concerned because you've gone from, hey, I don't have any properties to now having 7. Obviously these can be purchased all in the space of a month because you have the cash available, or you can take some time with it. You can go in, as I like to do with my clients, is walk them through and mentor them through the first purchase. Hey, this is when the rent comes in into this specific account. Let's set up an offset account so we can reduce how much interest you're paying. We then have a way we're gonna pay council rates, we're gonna pay insurance. We have a system in play, right? If you go and purchase 7 properties, you're gonna be overwhelmed. But that's where it helps having a professional by your side that can mentor you along the way, okay? So we've gotten 7 properties and we purchased them at $250,000. We're not paying LMI at the moment, although if you're in your acquisition phase, you're early on in your journey of creating a portfolio, leverage as much as you can. A lot of my videos, if you haven't checked them out already, they're all leading to one sort of answer. It's that RBA cannot increase their rates for the foreseeable future. I'm not sure when you're watching this, but we're at a point in the economy where debt is good. We can use debt, productive debt, to create generational wealth. And especially in the time we're in now, we can ramp that up at a whole new level. You use this strategy of getting the equity out, we can really supercharge your retirement. So we've now purchased these 7 properties. What does this actually mean for me? Okay, so we're gonna rub this off and we're gonna go into a bit of a cash flow analysis. So we know the purchase price was $250,000. We know that our loan is at 80% of 250 because we paid 20% in deposit. So our loan is 200K, right? Now we've got 7 of these, okay? So we're really gonna break it down very soon. But now you've utilized the help of a professional like myself, and we've been able to secure these properties below market value. Now, if you don't know what that means, head over to the video. It's gonna be a link up here or a link in the description. Really talks you through about why a buyer's agent is a requirement in terms of building a supercharged property portfolio that gets you moving very quickly. So market value of these properties are say $270,000. So you've got instant equity of 20K going into the deal. We then have a cash flow play of rent being, let me just scroll down. Okay, so the rent on each of these properties is $350 per week. And you've got to obviously times that by 7. You've then got rates and insurance. So you've got rates, insurance, and that's roughly about $4,000 per property. And you've got to times that by 7, right? I'm just showing you sort of your recession-proof properties that I've got part of my portfolio that really are going to move you through cycles. You're able to hold quite a few of these. You've diversified the risk. You've purchased, in different states, in different regional centers, that allows you to really get into a position where even with 7 properties in your traditional mindset or your parents' traditional mindset would have been impossible, right? You're investing in Sydney where you're so negatively geared, you can't afford to hold all these properties. But I would rather hold more of these recession-proof, cheaper properties that are more affordable, because it means I've always got a tenant, I've always got a buyer in play, and it means my positive cash flow position allows me to repeat the process time and time again. So we've got rates and insurance, rent, and we've got our repayments. Okay, so repayments would be, to work out, would be $57,000 across the whole portfolio at 3% interest rate. Okay, so your rent by 7 goes up to $127,000. You've got your rates and insurance, that's $28,000. Now, and then you've got 57K here on your total loan. Now, in order to figure out a couple of things here, I need to point out that your original loan would be 200K, right? So you've got 200K times 7 equals 1.4 million. That's the properties that you've purchased, but you also have the equity loan from the beginning of this video where we spoke about you're taking out the 500K, it doesn't affect your parents, you're gonna have to pay it off, right? So we've also gone plus the 500K equity loan, right? So this number here of $57,000 that you're paying in interest repayments is actually based on 1.4 plus 500K, meaning that your total loan is actually 1.9 million, okay? So as a cash flow position, you've got that as your income, you've got that as an expense, that as an expense. So your total income, cash flow positive is $42,000. That's per year, right? And not only that, but your asset value is 1.9 million. So asset value is 1.9 million, sorry. Now we're at 1.9 million because remember how we're purchasing at 250, but the real value is 270. So your asset value is 1.9 million. Your loan is 1.9 million. You have a cash flow positive of $42,000, and purchasing through a buyer's agent like myself, I like to use conservative numbers. I use 5% as a forecasted growth, right? Asset growth. In terms of my portfolio, a lot of people have been asking me, hey, you use 5%, but what's your portfolio growing at? And my portfolio is growing currently at about anywhere from about 7% to 11%. So when I say 5% is conservative, with all the growth indicators, all the forecasting and all the data sets we use to purchase these properties means that you're gonna get above average results. Average people are getting 3, maybe 4%. I'm saying we're gonna use 5% conservatively, but if I'm purchasing property for the last 6 years, for myself, for other people, we're looking at 7 to 11%, but we're gonna use 5% as a guide, and that equals 95, I believe, 95K per year. Okay, so a lot of numbers have been thrown. I don't want to overwhelm you, but we're going to go back to the beginning, okay? Obviously this is a video, so you can always rewind, check it out again. But summary is that you're going to have asset worth $1.9 million. You're going to be cash flow positive of $42,000 a year, year one, okay? You then have growth of 5%, which is conservative, across your portfolio. So all your assets are growing, and that gives you $95,000 of equity every single year, okay? This is all possible without you having actually saved any money. You've gone into the family's home, into the family or parents' home, and you've gone, hey, we have unused equity here. You guys are paying down the loan, and that's fantastic. But at the end of the day, they're gonna live in that house. They're not planning to sell it, right? So take advantage. Use the same equity that's there to then be able to go and purchase recession-proof properties that now, in a position like this, you've gone from, in the space of having 0 properties to having 7 in different locations, diversified. You then have positive cash flow of $42,000. So let's just figure out what that means. If you're currently making $65,000 a year, that's making $42,000. So now you've gone from your income being 65, you've gone 65 plus 42. Think about how many more choices you have. Not only that, but in the background, you've got the asset base growing by $95,000 a year. Are you gonna be able to save $95,000 a year? There is no way you're doing that by yourself, right? So what I'm trying to say here is you're actually not affecting your parents' lifestyle. You're not affecting their repayments. It's all the same, except you've now come in, taken advantage, and despite having to pay for the normal loan plus the equity loan, you've set yourself in a position where if you were to do this over the period of 2-3 years, you could effectively quit your full-time job that you may or may not like. In 3, 4, 5 years' time, you've built up enough equity to then go in and purchase, pay that equity loan out, or you can continue leveraging. Guys, this is very simple stuff if you know how to use the system. Debt right now is the cheapest it's ever been, and it's about to get cheaper. We are in such an unprecedented time. I know everyone's thinking about the virus, but we're actually in a huge chance that our generation, millennials, will ever get. If you aren't doing this, and you're showing this to your parents and they're thinking how they can fund their retirement, they could do the exact same thing. They could use the 500K, purchase 7 assets that are producing positive cash flow, which they can then use the $42,000 to pay off their home that they're living in right now. The loan that they've been trying to pay off for the last 10, 15 years. They could pay it off in the next 6, 7 years, depending on how they've structured it. Guys, what I'm saying here is not rocket science. However, it's not knowledge that everybody has. And once you have it, you're also still very scared of how it works. You're scared of how the risks are and how it adversely affects you. I'm here at Search Property TV helping people like yourself make those decisions, get through that fear concept, and really get pumped up about the opportunity we actually have right now. If you're interested, we can have a chat, we can have a property review of your portfolio at the moment. Despite if you have a few properties or you have nothing, it's always worthwhile to chat to someone that's gone out there and done something. So link in the description below. If you haven't already, subscribe to the channel, and please take action right now. Hit the like button and subscribe. I'll see you guys in the next video.